All right, so here's a checklist of things I look at before I buy a stock. First of all, I'll only look at blue chip stocks or big name companies. So companies that I trust are not going to disappear. So first of all, I'll look at companies that has a business model that makes sense, that companies that have a competitive advantage, companies that are selling a product or selling a service that's above average compared to other companies. So basically, a company that I'm confident is not going to disappear or is not going to go bankrupt. Because all I'm worried about is if a company goes bankrupt. So how do I learn about a company? First, just look around me. If I use a product, if I use a service, just my general opinion on the company based on what I see in real life, actual facts. Also, of course, going on Google. Google is your friend in this case, just searching about the company, going on the company's website, reading the About Us section, reading the annual reports. Although I don't always read the annual reports, but it would be a good idea to read it just to learn about the company's operations and company's future projection. So I've been trading or investing on the stock market since 2008, but I started off day trading, but not day trading with the full information, just day trading basically like a beginner. So I made some profits, and then obviously just because I made some profits, I thought I was invincible. So I continued trading the same way I was trading until I lost more and more money. So I then switched to options trading because I heard you can make much higher returns. And I remember in 3 months, I turned $5,000 into $14,000. I was really happy. And once again, I felt very invincible, and that any trade I make was going to be a profitable trade. And I remember this was at the time of BP when they had that huge tank that leaked oil in the ocean. And then I bought some BP options. Then I started buying some bad options, and my $14,000 turned into $6,000 in 1 month. So that's when I realized not gonna do option trading anymore. So then I started paper trading a lot, which is basically pretending as if I would buy a stock, but without actually putting real money, just to see how many times I would be right if I had bought this stock at this price. And what I realized is, regardless of the price, whenever I bought a stock that dropped for whatever reason, as long as I waited long enough, eventually the stock would go up and I'd make a small profit. So I realized I should stop trying to make a living off the stock market, but I should see it as an investment, as a way to grow your savings, not a way to generate income. So when I made that distinction, growing my savings versus generating income, I realized that it's very doable, very easy to be profitable in the stock market, as long as you're patient and as long as you're not greedy, and as long as your playground is blue chip stocks. So right now, all I focus on is big name companies that are not going bankrupt, they're not going to disappear. Basically just watch them, keep them in a watch list. Whenever they drop for whatever reason, usually it's for silly reasons, or reasons that have nothing to do with the company's operations or the company's performance or the company's strength. So I'll just buy them when they're at a 52-week low, or even more at a 2-year low. Make sure that they pay dividends first, buy them, and then once eventually they'll go up. If they take longer to go up, then at least I'm collecting dividends. I'm making money while I'm waiting. If they go lower, I'm also collecting dividends, and if they go even lower, I can buy more of that same stock. So that's been my strategy for the past 3 years, and I've been profitable every year. I think last year, the 2017 calendar year, made about 14%, and I have a video showing all my trades in 2017. 2018, we'll see. I have a lot of losing positions. I haven't sold them, but I have a lot of losing positions, I guess because the market has been much more volatile this year. So let's take Bank of Nova Scotia as an example. What do I look at? So first of all, I'll look at 52-week range. That's the first thing I look at. So I see that 52-week low is 70, 52-week high is 85, just to see if there's a big enough difference between the 52-week low and the 52-week high to see if there's enough capital gain that can be made. Now, just because it's been trading at 85 in the past does not mean that it's going to trade again in the past. It doesn't guarantee it. but I see it as a very good indicator that it will trade at that price again. So it's not a guarantee, but it's a very good indicator. And the reason why it's a very good indicator is because that's the general direction of any stock. The general direction of a stock is to go up. I mentioned it in many videos. A huge team behind the stock, behind the company, pushing hard for the stock to go up. So as long as I'm buying a stock that makes sense, a company that makes sense, that has a sound business model, that has a competitive advantage, eventually it's going to go up regardless. So these little hiccups on the road is just perfect buying opportunities. Once again, as long as you're buying blue chip stocks, as long as your playground is blue chip stocks. So I'll look at the 52-week range if there's a big enough gap. I'll also look at how hard it fell. If it falls steadily, usually it's on a downtrend, usually means that it's going to continue to fall. But if it falls hard all of a sudden, bigger chance that it's going to go back up pretty soon. But when it drops slowly, steadily, it usually means that it's going to continue to go lower. But nothing drops forever. Eventually it's going to go back up, but it looks like it might drop a little bit more before it goes back up. So I'll look at 5 years also to see how long it's been trading at 85, for example, at the 52-week high. I want to see how long it's been trading at that price. Did it reach it for only like a week and then drop back down to the 70s, or has it been trading at 85 for a long time? So you can see it hasn't been trading above 80 for a very long time, from September 2017 to January 2018. So it's been trading above 80 for maybe 6 months. So it hasn't been trading above 80 for a long time. It's mostly trading in the 70s and 60s. So it looks like it might drop a little bit more. And this here, I'm looking at the 5-year chart. But if I'm looking at a 1-year chart, this price is a 52-week low. Regardless, because I don't know what the lowest point is, I can only guess what the lowest point is. So as long as it pays the decent dividends, so 4% and above, I'll consider it decent. And then I don't mind buying in, at least while I'm waiting, I'm collecting dividends. And if it does go up, then I bought at the right price. And this stock did actually reach 78. I bought it at 76, it went to 78, and then it dropped a bit more. So it might go back up starting at this point, who knows, but regardless, it still pays good dividends. It's still a very safe stock to buy. Yahoo Finance gives it a 1-year target price of 86. So I'll look at the target prices that experts give. I'll read analyst reports as well. And if there's more people saying the same thing, then that's going to encourage me to buy the stock. So I'll look at 52-week ranges. I'll look at dividend yields. So PE ratio is important to look at, but personally, I don't look at it. Basically, it's price to earnings ratio. So basically, it's a way to evaluate a business. So a pizza store, for example, a pizza shop, if they want to sell their business, they'll usually sell at a 3 to 8 time multiple of their yearly earnings. So that's just like a general way to evaluate a business. It's not the only way, but it's a quick way to value your business, to see what it's worth if you want to sell it. It depends. It relies on the sector you're in. If you're in the food industry, if you're an e-commerce business, if you're a retail store. So it really depends on the sector you're in. But usually, physical stores will usually be between 3 to 8. But as you can see on the stock market, there's nothing between 3 and 8. For example, Bank of Nova Scotia, you could see here it's trading at 10. But 10 for the stock market is actually considered low. And you'd have to compare it to competitors in the same industry in order to know if the PE ratio is a good one. But I don't look at it because even if it is low, it's still not a confirmation to buy the stock. So what's great about Finwiz is that when you run a screener, it gives you the PE ratio right here, and it actually tells you compared to competitors in the sector if it's a good one, if it's a low PE ratio or a high PE ratio. So when it's green, it means it's good. When it's black, it's neutral, and when it's red, that means it's pretty high. So Bank of Nova Scotia gets a 10.44 PE ratio, and it's green, so it's pretty good. It's a low PE ratio, like I mentioned. But if you look at a stock like Netflix, it's got a PE ratio of 110, and it's in red, so it's pretty high. Yet Netflix could still be a good buying opportunity because it dropped pretty hard compared to the 52-week high, and it's got great growth potential. But personally, I wouldn't buy Netflix. But a lot of people are saying Netflix is a good buying opportunity. So what I care about more is the numbers, the financials, the income statement, and the balance sheet. So first, it's the business model. It has to make sense. It has to prove that it's got competitive advantage. It has to have a track record. And you'll hear a lot in the finance world that past performance does not guarantee future performance, but it's definitely a good indicator. So I'll look at the balance sheet, of course. I'll see if revenue is growing year after year, because that's what's going to make a stock go up, is the growth and future growth, of course. So I'll look at the past 4 years, if the revenue is growing consistently year after year. And of course, just because it grew last year doesn't mean that it's going to continue growing. But it's usually a very good indicator that it's going to continue growing. And by reading news on the stock, you'll hear about their future projects, so you can predict if, depending on the market they're in, if there's growth potential for the stock. And of course, I'll look at net income, profit also consistently with revenue, because revenue could grow, but expenses are higher and they don't make profit. At the end of the day, it's all about the profit, because profit is what fixes everything. Profit is what's going to pay down the debt. With profit, they can increase their dividends. So it's all about profits at the end of the day. So their profit needs to grow consistently as well. So if we look at Bank of Nova Scotia, you can see that revenue is growing consistently, not at a crazy growth rate, but for a bank, it's a good rate. And profit as well is also growing consistently. So based on the income statement, it doesn't explain why the stock is dropping. So for me, this gives me confidence to buy the stock. And just the fact that it's a big bank in Canada, even if it had bad numbers, I would buy it. So in the balance sheet, I would compare current liabilities with current assets. So as you can see here, they've got more debt than they have assets. They have more current debts than they have current assets. So that means if they ever had to pay down their current debts, they wouldn't have enough money to pay for their current debts. Usually long-term debt will usually have a collateral as an asset. We'll usually have an asset as a collateral. So long-term debt is not a big deal because it's used to buy an asset that generates revenue. And it's normal for a company to have debt. It has to have debt because that's how you leverage the company's, that's how you leverage the bank's money, by borrowing at 3 or 6%, but investing it in assets that generate much, much more. So taking advantage of the bank's money is really how a company can grow their profits. So it's normal for any company to have debts, but their debts should not surpass their assets. So as you can see here, total assets is 915 billion, while their total debt is 853. So they've got more assets and liabilities, but very, very slight difference. So I'll look at that, and I would also look at recommendations from analyst reports that say, for example, this is a buy recommendation, or this is a strong buy recommendation, or a hold recommendation. So I'll look at that too, and if all these indicators are positive for me, then that'll encourage me to buy the stock. So yeah, so that's basically what I look at. Doesn't mean that it's the right thing to do. There's definitely other ways, and there's definitely more things to look at. But based on my experience, I've realized that I don't need to do more than that. Profitable for the last 3 years. What I really need to focus on is not to get greedy, not to want more, because when I do that, I start investing in options like Ford, and right now I could risk losing the $1,600 that I put into Ford options. And just to keep focusing on my strategy and making sure that my playground of stocks is blue chip stocks, and making sure to buy stocks that pay dividends, so that at least I'm making a 4% return on my investment, even while I'm waiting for the stock to rebound. And as soon as it rebounds at least 10% from my purchase price, then I'll sell and I'll move on. And usually I'm able to do 10% between 1 month and 6 months per trade, and I just keep repeating the process. Last year it took me less time to make profitable trades. This year it's been taking a bit longer, but we'll see at the end of the year. Hopefully I'll be profitable. All right, so if you have any questions, leave them in the comments below. Once again, if you can open an account with Questrade to trade on the stock market, use my referral code in the description below the video, so you can get between $25 and $250 cash back. Thanks for watching.